Hey guys, if you look right here, I finally did it. I've been resisting it, but you've asked and asked, and so I broke out the dry erase board for you. We're going to start doing more case studies on it, right? I'm going to show you here in the next few weeks a couple case studies of properties that we actually did where those homeowners told us that they had over 30, 40 people walk through the house, investors, and they all passed up on it. And we bought those houses and we made a lot of money, and I'm going to show you those case studies, and I think that they're going to be very beneficial for you and your business. But what am I talking about today, right? I'm going to talk about how to finance rental properties and the two most common ways of doing it, which way you should be doing it, and then eventually down the road I'm going to show you the way that I do it in a future video, which I think is the absolute best way to do it. So if you're curious to find out about that, go ahead and subscribe to the channel and you'll get notifications when the new videos come out. But today we're going to talk about this case study here. We have two different investors, investor A, investor B. Now the investor A is the traditional way of buying a rental property. It's you go to the bank and they finance it for you, but you have to leave $20,000 into the deal if you're buying a $100,000 house, because they're only loaning 20%. I mean, they're only loaning 80%. You're going to have to leave 20% cash of your own money, skin in the game, right? But it's a good way to do it if you can get a rental property, but the problem is not a lot of people have $20,000. Nor if they do have that, or they have a little bit of money, which we're going to use a $100,000 example, starting capital in this video, you're going to run out eventually. And we're going to show the difference between the two different models. Now, the second one is a refinance. I just call this a fix and finance method. So we're buying a house, we're fixing it up, we're forcing the appreciation up, and then we're going back to the bank and financing out once we get a higher appraisal. A lot of people call this the BRRRR method. That stands for B-R-R-R-R. I think that's enough R's, right? Started to sound like a pirate there for a second. But what that stands for is it stands for B is for buy it, R is for rehab it, so you're doing the same thing. We're fixing the property up, we're forcing appreciation. Then R, rent it out. Start getting the seasoning requirements going for the bank. A lot of banks require that you have to have the property seasoned for X amount of months to show that the property is producing, and it's producing at the rate that you said it does and said it will. And then they'll verify that. Then you can go back and refinance out that loan. And most of them right now are doing an 80% refinance, a takeout loan, right? But some areas and some banks, depending on your relationship and your background as far as your financial records, are doing 85 cents on the dollar, and a lot of them will only do 75 cents on the dollar. And what I mean by 75 cents on the dollar is if you have a $100,000 appraised value, they're only going to loan you $75,000 against that $100,000. But most commonly it's 80%. So I'm going to go through and show you the difference between these two. Now, why do I have these numbers up here, right? Well, if you only knew that 20 rental properties would retire you or get you into a position where you had a great, comfortable life that you didn't have to work if you didn't want to, how hard would you work to get them? What would you do to go get those properties, right? So these stand for your rental properties. We're going to just leave up there for 10. Let's use the first case study, right? Both investors, the both traditional investor and both the investors doing the refinance method, are starting out with $100,000 capital. Whether it's your money or you borrowed it from an investor or a family member, you only have $100,000 to start. So we take the first investor. They find a house that's worth $100,000. A and B both finance properties for $80,000 out of the $100,000 appraised value. 80% loan to value, right? So you have $100,000. You go to the bank to buy this house and they say, okay, we agree it's worth $100,000. It's appraised at $100,000. Here's what you're going to have to do to get it. They're going to finance 80% of it. They're going to give you $80,000, but you're going to have to leave $20,000 of your own money in it. So you're leaving $20,000, so now you have $80,000 left, but you have a rental property, right? I hope you can read that. I don't know. We'll try to get better at this in the future, but you have $80,000 left. You come across another property, right? You want to buy that one. You go back to the bank, same thing. They agree it's appraised for $100,000. They loan you $80,000. So now you have $60,000. $60,000. Boom. Two. The third one, $40,000. Boom. I don't know why I crossed that out, but I'm doing it. $20,000. Boom. Now you've got $20,000 left to your name. What are you going to do? Are you going to use that money to keep marketing or keep that money in a reserve in case something happens with your property with vacancy loss or you need some repairs? That's the smart thing to do it, but most people don't. They get greedy and they want to get to that financial freedom number where they bring in big cash flow. They're going to go get that fifth property. Now you're broke. You have no money left, right? Unless you're bringing in money from your job. So you can see really quickly how you can run out of money. Now, a lot of people don't even have any money. So how do you get a rental property, or how do you build a portfolio if you have no money or you run out of money? Now, this is a great way to do it, because say you're cash flowing. We'll get down to that, because we'll go through these numbers here in a second, and I'll show you the difference between the cash flow numbers and how it breaks down. But there's another way to do it, and this is a better way to do it. And this is where it requires that you either use your own money, a credit line, a private lender like a family member or a friend, or you can even use a hard money lender to do this. So let's take, for example, the the BRRR method, right? The BRRRR method. We're going to refinance out. So we borrowed $100,000 from someone, or we had $100,000 of our own money. We go and buy a house for $50,000, right? Say we buy a house for $50,000. It's going to need $25,000, or let's just say it's going to need $20,000 to do all the repairs to force that appreciation up to where the value of the property is now worth $100,000. So we're going to have $20,000. Now we're going to have carrying costs. We're going to have some closing costs and extra fees that go into the property. Let's just say everything adds up to $10,000. So our total liability into the property is $80,000 total. But now it's worth $100,000. We can take that, go back to the bank now and say, look, we have an appraised value of this property for $100,000, and they're going to say, I agree, it is worth $100,000. Now they're going to loan you $80,000. You take that $80,000 that the bank gave you, it pays for all your carrying costs and your loan fees that you paid your lender, it pays for the $20,000 in repair, and it pays off the underlying $50,000 loan that your lender gave you to buy the property. So now you have a fully financed rental property where you have 20% equity and you're creating cash flow, and you have your original money back that you borrowed from your lender. So let's take for this example, right? So say you have a candy bar here and $1 here. You go to the gas station and you're a little kid and you're hungry. You want a candy bar. So you go and you get a candy bar and you hand them $1. Now you don't have any money, right? You have no money, but you have the candy bar. You eat that candy bar. The candy bar is gone now. What do you have? You have two empty hands. You have no money and no candy bar. That's not a good way to do it. That's kind of what you're doing up here, right? Except you still have the property. So it's actually a little better, but I'm just doing this for example. So if you do it this way, where you borrow $100,000, you have $100,000. You go use that borrowed money to buy the property. You buy it at a discount, $50,000. You put $20,000 in it. You have $10,000 of other liabilities. You bring it up to $80,000. You finance out, right? So now what do you have? You've taken the $80,000 that the bank's given you. So now you have a financed property that's 20% equity, and it's cash flowing, and you have your original $100,000 back. So you get a rental property, check, right? So you got one, but you still have your $100,000. And you can go buy another one and do the same thing with that same 100. So you go do the same thing. You buy one for 50, you put 20 in it, you have your 10 in carrying costs and closing costs, and you finance out for 80. You got another one, right? And you can rinse and repeat, 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 rinse and repeat. Now the full process, some banks require 6 months seasoning, not always. Some are doing a lot less, some are only doing 1 month. So you can use that same $100,000 to build a portfolio. So basically, let's say it's taking you 3 months to do it. Well, you can do 4 a year. In 5 years, you just created a retirement, a portfolio that is going to allow you to quit your job and never have to work again, as well as have a great retirement, because when it pays off, you're making a ton of cash flow, right? Because now you don't have an underlying principal and interest amount. Now let's kind of look at the numbers on the property and how this would break down. So you're financing a property at $80,000, 4.25% over 30 years, right? It's appraised at $100,000. So the bank's going to loan you everything. You're going to have $80,000. You're going to wipe out all your underlying costs, unless you're doing it the traditional way, which is where you're leaving 20% in. You're going to have a principal and interest amount of $393. Interest is $283, and your principal amount is $110. That means $110 is going to actually paying down the property each month, and $283 is going to the bank's pocket. Here's where we get to the taxes and the insurance. The taxes, let's just use $150, and insurance $150. That ends up being roughly $693, or we'll just say $700 to make it easy, as your total PITI, right? That's your principal, insurance, taxes, and interest. Say we can rent that property for $1,200. The cash flow on this property is going to be gross, not net, because you're still going to have vacancy loss and and repair costs, but let's just assume that because we did fix it up, we're not going to have any repairs, and that we are good at what we do, and we put a 2 or 3 year lease in place, so we're not going to have any of these extra costs. Let's just assume they're making $500 cash flow. 500 times 12 is $6,000. So if you go up to here for your first property in the traditional way, you've got 6,000 divided by 20,000, which would be, what is that? That's 30%. That's a 30% cash on cash return on the money you have invested. Let's take the same example where we borrowed the money, we fixed it up, we forced depreciation, we financed out, we have none of our own money, and we paid off our first underlying lender, and we still have that lender's money now to go buy another property, but now we're making $6,000 and we have $0 invested. How many deals can you do doing that? An infinite amount, because you don't have any money. And a lot of y'all think you have to go raise a ton of money. I just showed you how with borrowing of $100,000 you can do this same deal, which we've done this exact same deal multiple times in the past few months, that you can borrow $100,000 and use that to build an infinite amount of properties. Now, you're going to run out of time. That's why you need more lenders and more money, because you can do it quicker and faster. So we're leveraging the banks to create a portfolio quickly. So I hope I kind of broke down the difference between the two. You're going to run out of money if you're leaving your cash in there. So the best way to do it is to buy it with borrowed money at a discounted price, force the value up, repair the property to force depreciation, and go back and finance out and rinse and repeat doing it that way. So I hope I kind of went through this case study here and this kind of explained the difference between the two of them. And next time, I'm going to give you something else that's going to help you with your real estate business.